Well, it was a busy week in the financial markets last week. The Fed skipping, the ECB hiking, the Bank of Japan not really doing much at all, in all honesty. Equities really shrugging off the FOMC's decision, the S&P 500 rallying for a fifth straight week and printing new year-to-date highs. But it was a bit of a different story for the dollar, which was softer against most of its DM peers, notching a third weekly loss when you look at something like the dollar index. Another busy week awaits. Fed Chair Powell heading over to Capitol Hill. The BOE set for a 13th straight rate hike. And we've also got central bank meetings in the mix as well from Switzerland, Norway and Turkey. It's another jam-packed episode of The Trade-Off this week, so let's get into the show. So a hell of a lot for us to get our teeth into this week. It was a bumper week of event risk last week. It's another busy one this week as well. Let's bring in my co-host, Ryan Littlestone from Forex Live and Forex Analytics. Ryan, good to see you, mate, without your dodgy background this week. How have you been doing?
Yeah, all good, mate. I did purchase a little memento of the occasion, so I've still got that on my desk. I think it's about the real size of it, but I'll bring that up over the months ahead when you talk about your trophy of the season. But, you know, we're in the cricket season now, so we should lay off the football.
Well, I was going to say, I did want to talk about the cricket as well, but we're filming this at lunch on Monday in the first Ashes test, and things aren't going especially well there either. So I think we may make the trade-off a sport-free zone for the next 6 weeks or so, at least until the Premier League comes back.
Yeah, definitely. And as you said, we've got a busy week ahead, more central banks on the cards. Obviously, the BOE being the big one, and we'll see what mess they can make this week.
It is, yeah, and I think mess is probably the operative word. But before we get on to the BOE, let's take a brief moment to look back on what was a busy week last week, and let's get into Topical Thunder. I mean, those segues were very neat and smooth in the intro there. It's only going to go downhill from here, isn't it? Let's be honest. The Fed, what did the Fed do last week? Well, they didn't really do anything when it came to interest rates. The target range for the Fed funds rate remaining unchanged at 5 to 5.25%, as I think pretty much everyone, apart from maybe Dick Matthews, had been expecting going into the decision. Certainly that was what markets were pricing in. But I think when you look beyond that decision on rates, which, as I said, everyone was pretty much expecting, the meeting was arguably as hawkish as the Fed could reasonably have got. If you look at the dot plot, the median dot for 2023 was revised higher by 50 basis points to 5.6%, which implies as much as 2 further rate hikes to come between now and the end of the year. When you look at the inflation forecast, both the PCE and the core PCE inflation forecasts were revised higher. The core PCE number now expected to end the year just under 4%, and both measures set to remain north of the 2% target for the entirety of the forecast horizon, which goes out until the end of 2025. And then when you look at the press conference, which some of us unfortunately are forced to watch when the sun is shining on a nice breezy Wednesday evening, Fed Chair Powell was pretty punchy and pretty aggressive, saying that the July meeting is going to be a live meeting, saying that the risks to inflation are still skewed to the upside, being very aggressive in ruling out cuts this year, saying that they're not appropriate, and then letting the cat out of the bag a little bit, saying the skip, and then saying, oh no, maybe I shouldn't call it a skip. So a little bit of a Freudian slip or Freudian skip there from Powell at the press conference, really saying, yeah, we're not hiking now, but we are going to move again in July. But what's interesting out the back of all of this is that the market hasn't really bought it. As I said in the intro to the show, equities higher for a fifth straight week. The S&P 500 printing new year-to-date highs. We'll have a look at the Nasdaq in a little while. That's its highest level since Q2 of last year. If you look at money markets, overnight index swaps, price terminal rates about 5.3%. I think they give a 6 or 7 in 10 chance of one more hike. But it's not really the hawkish repricing or reaction that I think the Fed would have wanted to engineer out the back of the June meeting. And then, of course, the dollar, which stumbled last week, the dollar index touching the 102 handle, which is its lowest since mid-May. And I want to get your thoughts on two things, Ryan. Firstly is, why do you think markets haven't bought this pretty aggressive, pretty punchy, pretty hawkish stance from the Fed. Fine, they didn't hike, but they've done everything they could to telegraph that a decent chunk of further tightening is on its way. And secondly is looking ahead to the calendar this week, Wednesday afternoon, Thursday afternoon here in the UK. Jay Powell is heading over to Capitol Hill for his semi-annual Humphrey Hawkins testimony. How hawkish do we reckon he's going to be there? I mean, his message has sort of fallen on deaf ears so far. So does he up the ante a bit and really try and ram that home this week?
Yeah, well, I think he was round about what we said he was going to be like last week on the show. You know, he had to. The main message from the FOMC was that we may be pausing, we may be stopping hikes at some point, but we're going to keep them up. And the way they emphasised that was with the dots, moving those dots much higher than expected, with Powell keeping the hawkish tone. And it's all about appearances, because if they give an inch, if they turn around and say, right, well, we're close to a top, that's it, we've got our terminal rate, we're not going any further, the next thing the market's going to do is trade cuts. And that means unwinding all the hikes that they've had so far by selling the dollar, bringing yields down, lowering interest rate assets, and so on and so forth, and undoing a lot of the work. And with central banks, they need to keep what they've done in the market. It's the same with the ECB, as we're going to talk about. So, you know, how hawkish can he be? He can't say we've got 10 more hikes on the table, because that's not the case. So the market knows we've probably got 2 hikes maybe in the pipe, or we may be close to a pause. That's as high as we're going. So it can assess its own terminal rate, if you like. But the message from the Fed is keeping that in the pipe and making sure the market doesn't get too dovish thereafter. And as for Powell this week, unfortunately, these things tend to not be as market moving as we might like. It's going to be a repeat of what he's just said last week. He's going to push that message. Of course, this is politicians, so they're going to ask all sorts of stupid questions, which we have to sit through, unfortunately. I'm just thankful it's not Yellen, because, oh boy, those ones were really dull.
Yeah, and also the voice, you know, fingernails down a blackboard type thing going on there. These hearings, they do annoy me a bit. You know, they're a really good opportunity, and I'm in danger of going on a rant here. I'll try not to. But, you know, central banks are independent. They're accountable to lawmakers who give them their mandate. Lawmakers get, in the US, 2 opportunities a year. In the UK, they get 4 to really question and probe these central bankers on what they're doing now, what they're going to do next, interrogate some of the mistakes that they've made. And plenty of mistakes have been made in terms of a policy and a forecasting point of view over the last 2 years or so. But all these politicians are more interested in sitting there and giving a 2-minute long diatribe that some intern in their office can then clip up and go and put on TikTok to say, oh, aren't they doing a brilliant job? It's a total waste of time. And, you know, it's tough to feel sorry for a bloke who's paid a couple of $100,000 a year, but in many ways you do feel a bit for Jay Powell and his colleagues who have to sit through this nonsense when they probably want to have a bit of decent back and forth in terms of the real economic issues of the day. But, you know, such is the fickle world that we live in, I suppose.
Yeah, I mean, fortunately, there's often the odd one or two politician who knows about finances and financial markets. So we may get a couple of proper questions coming out, but yeah, by and large, about 2 hours in, I'm usually nodding off or as you say, switching to the cricket.
Yeah, most definitely. Well, let's leave that there before I go into full Victor Meldrew mode and get on to another favourite subject of mine, which is the ECB.
Yeah, well, obviously, we had the ECB last week, and Lagarde really has kept the ball rolling here. You know, some of the market were thinking, well, maybe this is the time when the ECB is going to maybe move towards a pause. But no, they hiked, kept a hike on the pipe for July, kept the door well open for September. And, you know, the market bought what Lagarde was selling, perhaps more than they did what Powell was selling. And, you know, they did their own version of the dot higher for longer move by moving up their rate expectations. I mean, between December and March, actually brought them down for the last projections. But this one's, they took all their CPI numbers up by a pip. Only a small move, considering we see inflation moving, you know, 30, 40, 50 pips each time we get a print. So not a big move in terms of numbers, but a big move in terms of intent to say, we still expect inflation to be sticky. We're going to still keep hiking. Again, it's reinforcing that message that although our hike cycle may be coming to a close, we're still going to have to keep rates up there, and we're not going to give any doves and any market bears an inch in turning around what we're doing here. And the hiking cycle may be drawing to a close, but the next big trade will be when and if the ECB and all the other central banks look to bring rates down, when they start coming down to this neutral level that we've been speaking about on prior shows. But for now, we need to keep watching the data. If inflation stops going the right way, the ECB and all the other central banks are going to be in for a rough time, I think.
Yeah, absolutely. I mean, the ECB is an interesting one. I very much enjoyed the ECB decision this week because I was out for lunch rather than sat at my desk staring at the Permatand one giving her press conference. But there we go. I think it is an interesting one, just in terms of the volume of speakers we've had since the ECB decision itself. I mean, it's been wall-to-wall coverage. Any policymaker that they can find in terms of financial media has had a microphone stuck in their face, and the line, even from some of the more dovish members, has been very much a case of we're going again in July, almost no matter what. And then we will probably go again in September. I think there's going to be a very heated debate around that. I know this time last week, I think we were talking about the ECB, and I was saying maybe September's a bit of a fudge. They don't raise, but they do something on the balance sheet. Well, actually now it looks more like they could actually hike again in September, and then the pause, skip, hold argument becomes a conversation for Q4, even later in the year. And obviously the euro has strengthened on that. I just can't help but thinking, and I don't want to be a little bit premature on this one, but are we rerunning the whole Trichet 2010, 2011 thing here? Because the Eurozone is in recession. We get the latest PMI numbers on Friday, I think it is. Friday morning, we get the flash PMIs. We're expecting a deterioration there across all three of the gauges that we get, manufacturing, services, and the composite gauge, of course. Inflation is still too high, yes, but it is coming down quite nicely. It does seem to be trending lower, and more importantly, trending lower on the core inflation metric in the Eurozone, which is something that we're not seeing, well, certainly in the UK and also in the US, if you annualize some of the month-on-month core data. So I just wonder whether they're not pre-committing to anything beyond July at this point. I think July is a given, but by increasingly talking up the chances of raising rates in September, they could end up backing themselves into a bit of a corner here and delivering something that is, they're really running the risk, I think, of actually over-tightening, which is probably one of few, maybe the only central bank who's in that predicament.
Well, maybe, but we've had ECB members saying that they prefer to over-tighten than under-tighten, so they're happy to keep going. And as we know, it's all on the data, so we need to keep watching those data points. But there was a couple of other things that came out. We got the usual ECB sources later on in the afternoon. And one interesting point was that they're going to be potentially looking at the corridor for the three rates that they've got, because pre-2014 or up to 2014, they all used to be the same level. And then as we came through all that mess, they had different rates for different ones. So they might be bringing those together, whether they go from the lowest to the highest, i.e. the deposit rate, up to the marginal lending rate, or bring the marginal lending rate down. That might be construed as a hawkish or dovish move once we get to whatever terminal rate is. But we've had ECB's Lane coming out, chief economist of the ECB coming out, that inflation is going to fall really quickly this year. And I saw someone on Twitter saying, well, how can he say that when their own staff projections have just hiked all the CPI rates for the rest of the year? So if the chief economist doesn't know what's going on, how can the rest of them know either?
Sums it up, that, doesn't it? It really does sum it up. I've already had one rant. I'm not going to have another rant. Well, I am, because we've got to talk about the Bank of England. Joy, oh joy, the BOE. What on earth are we going to get from the old lady down the road on Threadneedle Street this week? Well, they're going to raise rates by 25 basis points, I think. And actually Thursday, incidentally, before we get into the BOE, is a busy day for central bank decisions. The Swiss National Bank kicking things off bright and early Thursday morning, 8:30 UK time. decent chance they might go 50 basis points, actually, considering that they only meet once a quarter, and Chair Jordan was relatively hawkish the other day as well. The Norges Bank a little bit later on, they're going to raise rates by 25 basis points. Keep an eye there on what they have to say about the Norwegian kroner. But of course, the main focus for us here in the UK, and the meeting that's likely to have the broadest cross-asset impact is going to be that of the Bank of England. So a 25 basis point hike, that would take bank rate to 4.75%. I think it's almost guaranteed to be a divided decision once more. I would say my base case is that it's a 7-2 vote, with Dingra and Tenreiro dissenting in favour of keeping rates unchanged. But complicating matters a bit there. This is Tenreiro's last meeting. She's off in a couple of weeks. She got some sort of honour over the weekend, which is just mental. She's been pushing for cuts. She's been calling for rate cuts for a while. Does she vote for one in her last meeting? I guess there's a better chance now of it happening than at any of the other ones she's attended. But given that her term is over and the hopefully more sane Megan Green is taking over very shortly, I wouldn't expect markets to read too much into that. I think what's more important with the BOE, and bear in mind, we don't get a press conference from the BOE this time. We don't get any new forecasts from the bank either. So it is all going to be on that statement and on the minutes of the meeting that the markets have to read very, very closely into. I think what's really interesting is what comes next. We've had a really significant hawkish repricing in the rates market since last Tuesday, actually, when we had the jobs data out of the UK. The labour market incredibly tight, earnings growing at 7.2% on an annual basis. That's a record pace, take out the distortions around the pandemic, and unemployment coming down unexpectedly to 3.8%. So we now see markets pricing in a terminal rate of around 5.8%. About an even chance markets think that we get to 6% in terms of the bank rate. Gilt yields have gone through the roof. The 2-year gilt touching 5% earlier on for the first time since 2008. And of course, this is having an impact on the mortgage market as well. I mean, effectively, if you look at market-based interest rates, we've had another rate hike and a half from the BOE in the space of a week. It's an absolutely huge move. So I think what is the real focus for sterling and for anyone trading UK assets is, what do the BOE do in terms of their guidance? And on that front, I don't think they're going to do anything different. I think they're going to stick with this data-dependent guidance that they've had for some time, the bias towards tightening, but only on signs of more persistent inflation. And I think given that they're moving at 25 basis point clips, I think it's very unlikely we get anywhere near 6%, because getting there would require hikes at every meeting until February of 2024, and the economy is going to have gone south a long way before then. Ryan, I'll bring you in 1 second, but the last thing I want to mention on the BOE is about 24 hours before their decision, we've got the latest UK inflation data. This is absolutely pivotal, not only for the BOE's decision, but also for the pound. Obviously, we had that hot labour market data last week. We're expecting core CPI to remain at a 30-year high, 6.8%. Personally, I think the bar for a hawkish surprise from the BOE is a very, very high one. I would say risks to the pound as the downside. We'll get on to why later on. But how are you seeing things, mate?
Yeah, well, the first question I'd ask you is do you see them? Do you see it a tough ask for them to get to 6%, like you saw them getting to 5%? That's the first question I should ask.
Where are we going for lunch?
Yeah, I'm still planning where to go for lunch when you lose that bet. But anyway, I digress. Yeah, the CPI could be a bit like the Fed last week. It could be more important than the Bank of England itself, because no matter what the Bank of England does, if that CPI comes in this week really hot, if it's unchanged or even just a small dip in inflation, it's going to keep these expectations rampant for where the bank is going to have to take rates. And I think in that scenario, the market, we know Bailey's a reluctant hiker. He said as much as at the last meeting. He hopes he doesn't have to raise more. Well, that's a fable at the best of times. They're going to have to hike. They're going to have to hike more. And he's probably going to try and sell it that we need to see the effect of rate hikes coming through. That's why they might be reluctant to continue hiking. He's not going to say they're at a pause. He can't do that with inflation at these numbers unless it absolutely falls off a cliff on Wednesday. So anything that the market or he tries to give as less hawkish, the market may dip. We may see the pound dip on it, yields dip on it, but it's going to come right back in afterwards, and it's not going to believe a word they say. And well, that's been the truth of it for several years now. So I'm expecting anything that's dovish sounding to be bought up pretty quickly.
Yeah, I would agree. 6%. Let me just explain that very briefly, because I think that the only way the bank gets 6% is if they start raising rates in 50 basis point clips, which is possible. I mean, they did it last year, but I think looking at where the balance of risks lies, and also thinking about who's the most hawkish on the MPC, was Catherine Mann. And she's shown no inclination to even mention the possibility of raising rates at a faster pace. And I think it comes back to what Jay Powell was saying last week. It's now for all central banks, you know, I know the BOE are much further behind the curve than everyone else, but for all central banks, it's now a question of the level rates get to rather than the speed at which they get there. And I think with that in mind, it's tough to see the BOE getting to 6%. The housing market is, I was going to say there were cracks emerging. I mean, they're bloody great caverns emerging at this point in the housing market, looking at the state of it. Again, the PMIs will probably show growth rolling over. Retail sales a bit soft. GDP is going to fall in May because of the extra bank holiday. Things aren't looking great.
No, but I'm going to counter that somewhat because, you know, we've been saying it for the last few months. Inflation in the UK is a different beast to anywhere else. I think if you have to pick a central bank that might get rates to 6%, it's more likely the BOE than anyone else. I don't think if they're forced to continue raising, I don't think it was going to be every meeting they're going to hike. They may take the pause option and say, right, we're going to hold off for a little bit, see how that filters through. But when they see no reaction, if they see no reaction, couple of meetings down the line, they'll be forced to go again, and a couple of meetings down the line, forced to go again. So I think they can creep up maybe 5.5%, 5.75% in this current run before they finally see inflation doing what it should be doing. But yeah, I think 6% might be a bit of a top, and it's not going to stop the market getting there. And if we see that sort of extreme pricing, then we know, well, hang on a minute, now the BOE has to live up to that. And if they don't, that's when you get your turnaround in the quid.
Do I feel a double or quits coming on that 5% there?
We'll do double or quits after I've eaten. And
not sure that's how it works, really. In any case, I mentioned the housing market in the UK, and things aren't going great. 2-year mortgages north of 6% now on average for the first time since the mini budget. What about housing in the US?
Yeah, well, we're back to data watching after the Fed last week. And, the housing data is something that Powell spoke specifically on last week, saying that he thinks it may have found a bottom, and after slowing through their hikes. The truth is it never really slowed significantly, and prices, although we're starting to see some month-on-month drops coming in now, year on year, house prices are still rising. The rate may be coming down a bit like inflation, but it still gains. So, we have seen these moderate prices, but still remain strong year on year. And while many in the US may not be moving house due to higher rates, due to affordability, which then often puts pressure on prices, a continued lack of inventory is going to keep prices buoyant. So if we're going to see these lagging effects that the central banks talk about from rate hikes, this one remains one area that we perhaps could see some damage still coming in hard and fast, because the housing market is obviously it's very movable on higher rates. So among the numbers that we get from the housing data this week, and we get NAHB today as we're recording this, we get building permits and starts tomorrow, we get existing sales later in the week. Among all those numbers, keep an eye on the prices, because they could be the first indications of whether we are starting to see some real pressure from rate hikes coming in. And of course, as you mentioned, it's a similar situation that we're going to see in the UK here as well.
Yeah, absolutely. I mean, the big difference, of course, is that here in the UK, I mean, until a couple of years ago, a 5-year fixed rate mortgage was pretty much unheard of, whereas in the US, it's 30-year or nothing, which is why you've got a very, very different transmission mechanism when it comes to those rate hikes from the central bank, be it the Fed, the BOE, whoever, making their way through into the real economy. But I do think it's an interesting one. And I think, of course, given the fact that the data slate is a little bit quieter in the US this week, we've got the PMIs on Friday, housing data. We've also got the jobless claims number, sorry, that totally slipped my mind. We get it every week and I forgot. The jobless claims number on Thursday lunchtime. But it is a week where I think housing figures are going to come to the fore. And it's interesting because if we are going to start to see those signs of stability that Powell mentioned, then I think markets are going to go hunting for it in some of the reports that we get this week.
Yeah, definitely. And you make a very good point on the difference between rates in the US and over here in the UK. It's something I pointed out in our room last week. If you look at US rates as a historical average, they used to run about between 4 and 6%, even when rates were at zero. Mortgage rates were, still fairly high compared to the UK where, they dropped under 1%, and you could get some very good deals. And now that low line has suddenly taken off and gone parabolic, and all those people coming out of mortgages from 2 years ago are now getting slammed. But in the US, the difference has been much narrower. So they may have come out of 3% mortgage into a 4% mortgage, 4.5% mortgage, 5% mortgage. The gap's very narrow. So they're not going to see the effect in the US that you will in the UK. But house prices and affordability is something that is going to pop up in the US.
Yeah, absolutely. I think actually that's a very good point. And this is why I think I tweeted out a chart from Bloomberg on this last week. Because, people even now in the UK are fixing 5-year deals at 5.5%. So not only are we feeling the impacts of rising rates a lot later than in some other countries like the US, for example, but we're also almost prolonging the impact of that rate shock because people are locking themselves in at 5.5%. I mean, in 5 years, God knows where we're going to be in 5 years' time. I struggle to think where we're going to be in 5 minutes' time at this point. But, is bank rate going to be lower than 5.5% in 5 years' time? I'd say there's probably a pretty decent chance that it will be, even when you take into account the mortgage spread and the all the rest of it. So it's an interesting one. And when you then start to think about stagflation and scarring within economies caused by slowdowns and recessions and all that kind of thing, this then comes into the longer term thinking around, the UK, what's that going to do to growth? It's going to be a massive headwind to battle over the rest of the decade, I would argue.
Yeah, and exactly. And the banks love people coming in now and fixing their rates at 5.5%, 6%, because you're quite right. In 5 years' time, we would expect rates to be lower. So getting locked into deals, and we're not mortgage brokers, by the way, getting locked into fixed deals now is probably not the sensible choice.
Yeah, before someone in my compliance team comes and taps me on the shoulder, as always, this isn't advice, and especially when it comes to mortgages, this is even less advice than it normally is, which is none at all. Right, before we get into trouble, let's get on to some charts. I mean, I say that as if charts are a safe space. I'll probably get moaned at for having too many lines on my chart again, won't I, Mr. Weston, who helpfully commented that while he was perched over my shoulder this time on Thursday last week. Anyway, dollar CAD, let's have a look at that because we finally broken to the bottom of a range that has lasted for about 9 months or so now, between about just over 132 and just north of 139. We've been within that range since September last year, and we've finally broken to the downside of it. I mentioned Aussie CAD last week as a bit of a tale of two central banks. So I guess dollar CAD is a little bit similar. You've got the market thinking that the BOC may raise rates again in July. I think in total, the market prices in around 30 basis points more tightening from the Bank of Canada. Whereas, as we discussed earlier, the market is really not expecting the Fed to do much more, and certainly hasn't taken those hawkish comments and dots and forecasts from last week at face value. The other thing helping the pair out last week and certainly helping the loonie was a bit of a rebound in oil prices. I think the outlook remains rather bearish for crude, but of course the Saudi OPEC cuts have put a little bit of a floor under prices, and we seem to have reached that floor in WTI last week and bounced a bit, which did help the Canadian dollar to firm a little bit more. In terms of the chart, I think now we're below this 132.25 region, and importantly, we tested it again this morning and held it, which is a very good sign that this may indeed be a more prolonged breakout. There's a couple of nice levels to look for the bottom, 131.10, 131 the figure, and then of course course, the big 130 round number if the move is going to extend further to the downside. But as we've seen with quite a lot of dollar pairs out there in the G10FX space at the moment, we've come a fairly long way in a fairly short space of time, from 136.5 now down to 131.5, and really the momentum at the moment only seems to be going one way.
Yeah, absolutely. And we've spoken about the CAD before. It's a lovely pair to play technically. When it works well, it really works well. And as you say, we've got the break at 32.25. Well, the main break was up at 133. But as you said, it's holding the break. And technically, that's what you want to see. You want to see a level broken, held on a retest, gives you that conviction to get in if you weren't in on the first trade. And I think, yeah, we could get a move down. It's held up around about the 131, 70s, 80s for now. And, you know, I'm not sure why that is. I would have thought we might get a bit more of a push through after breaking 133s and then the 132s. But it's in the game. I think you're right. We could be seeing those low levels. If we can really confirm a move under 132 now, we should be heading for 131. I've got a level just below that 130.80 on my chart. After that, you're quite right. It's the big figure down at 130, and that's always a big psychological level. And if we get down there, then we're going to have to ask some questions.
Absolutely. We're going to talk about 130 again in about 10 minutes' time. So stay tuned for that. What about the yen?
Yeah, the yen. And, you know, watching everything yet last week, the thing that struck me was that a lot of people were talking about and focusing on the dollar. You know, we spoke about dollar yen, where it would end up at the end of the week. We were watching the 138, 141 range, whether it's going to stay in the range or go somewhere new. It's the latter, but the story really has been about the yen rather than the dollar. And, you know, many traders looking at their charts and looking at what's going on, looking at euro dollar, cable, Aussie dollar, incorrectly assuming that many of the moves we saw last week were down to the Fed pause bringing a weaker dollar. Looking at the Dixie as well, you know, you may think the same thing. I mean, that's one of the reasons why I hate the Dixie, because for me, it's the least important trading metric in FX. This chart really shows you what was going on. So there's two parts to this chart here. The first part is, as you see at the top, these are the spot returns, and they were taken from Monday through Friday last week versus the yen. You can see all the currencies they're gaining versus the yen, including the US dollar there at the bottom. And then if we look at the dollar side of the trade, again, all the currencies gained against everything except one, the yen. So it really tells you that the yen was in the driver's seat last week. So why is yen the weakest link among all this? I think a good big chunk of this is the good old carry trade. We've had all these central banks confirming that rates are going higher, staying higher, and we've had the Bank of Japan confirming that they're going to do nothing for the foreseeable future, where the market might have been hoping we got a few little crumbs dropped from the Bank of Japan last Friday. We didn't. So the carry trade, you know, you can earn some money being in other currencies against the yen. And I think that's picked up again. Market waited to get past these events, moved back into the carry trade, and can sit back and earn the money on the trades as they go along. What do you think of that, Michael?
No, I think there's definitely something in the carry trade. You know, you look at the other G10s in particular that performed well last week. The pound, obviously, rate expectations going through the roof. The Kiwi dollar did okay as well. Rates are pretty high down in New Zealand. The Aussie dollar as well, although, of course, that's a little bit of a high beta play as well. So, yeah, I think it is a case of the carry trade is finding a little bit of love once more. And, of course, what is the primary or one of the most important conditions within the market in order to look to get into a carry trade? Well, one of them is low volatility, because of course, if you're seeing major moves in the market, that could wipe out whatever you're getting, whatever you're earning to be in that position. And FX volatility is close to, or if not at, its lowest levels on an implied basis and probably on a realized basis as well since the beginning of the war in Ukraine. Volatility in the equity market, the VIX is at its lowest level since February of 2020. So I think the carry trade, it's going to be the summer of the carry trade, I think. And if it is, the yen is in for an incredibly tough time.
Yeah, no, quite. And you make a good point there, being the summer. You know, if trading volumes and liquidity and volatility is going to be dropping through the summer, then, you get into a carry trade and you sit and earn the interest while you're doing nothing. So it is a big part. But the important thing I wanted to make traders aware of is that a lot of people say everything's about the dollar. Well, here's an example where it's not quite all about the dollar. It's quite about some other currency, and how that can have a big effect on keeping the majors moving as well.
Exactly. Broaden your horizons. Move away from the US. There's other things out there going on, even though most of them don't think that. In any case, I am going to now totally contradict what I just said and go to the US with the Nasdaq. I chose the Nasdaq this week because I think a certain Mr. Littlestone in last week's show said something along the lines of I would be banned, probably from my own show, if I showed my chart of the S&P 500 once more, because I've used it too many times. And then he's brought up dollar China for about the 6th week in a row. So words are going to be had there, that's for sure. In any case, I mean, this is the same story, really. The equity market just continues to perform incredibly well. Tech is continuing to lead the way. So if we look at the Nasdaq in particular, we came north of 15,000 last week for the first time since the second quarter of 2022. And actually, we closed on Friday very, very close to, if not just a nose above the high that we saw in April of that year at around 15,270, if I can read my chart. You wouldn't believe I got new glasses at the weekend. I can barely see what's on the screen about 5 yards away from me. I'm not sure these specs are really doing anything. In any case, it remains a case of any bad news being thrown at the market. It's just shrugging it off. Soft data, well, you know, bad news is good news from a stimulus point of view. And speaking of stimulus, there's plenty of liquidity coming out of China to help things along. The rebuild in the Treasury General account, who cares about that anymore? It was a story for a couple of weeks, and now it seems to be on the back burner. Fed Chair Powell, hawkish at his press conference. It's a buying opportunity. It's a dip. We'll buy into it. And I think that is likely to remain the case for some time to come. We're moving into the summer. Volatility is low. Liquidity is a little bit thin. Volumes are a little bit light. There's a lot of momentum in with the bulls at the moment. The path of least resistance seems to be embedding itself higher. There's plenty of cash on the sidelines as well. If you look at the latest fund manager survey from Bank of America, institutional investors are still quite significantly underweight US equities. So I am staying long US equities, staying long tech. And if there's any dips, I would be buying into them quite quickly. What are your thoughts, Ryan?
Yeah, well, I haven't missed the fact that you've picked with the same drink, just gone to a different bar. So you're still talking about US stocks and just a different one. But yeah, the premise is still the same. Stocks look bullish. And I think we are getting into that point of the show where, you know, those late bulls or the bears who were thinking, yes, you know, 42 in S&P was going to be a top, 43 is going to be a top, 1500 in Nasdaq is going to be a top, and now realizing we might have missed this boat, and then we're going to see a wave of these chasers coming in. So we might find that we have a bit of a last hurrah maybe before the summer, pushes us up maybe back towards those highs, and then the market may settle down from that point. If you take a wider look at all the stock charts, S&P, this, whatever, if we get up to those really big highs that we saw previously historically, that's going to be the big test. If we hold around those highs, we could be in for some really big moves and you know, some real massive double tops. That's the sort of thing I'm going to be looking at because that's the ones that bring you the big moves and the big pips if you can grab them.
Yeah, absolutely. Now, I'm going to run the risk of our compliance team again here because I just want to mention very briefly options. They are very complicated products, of course, but calls on the Nasdaq and on the S&P around those highs that we saw in late 21, early 22 are quite cheap. And I think we're going to start to see increasing institutional interest in playing this through options because there's going to be more and more people sat on those desks saying to themselves, it just feels like the market, whether I like it or not, whether I'm bullish or bearish, it just feels like the market's got it in itself to move and test those levels. So I think that's something worth bearing in mind, having in your head what those institutional players are doing, and also bearing in mind the impact that it has in terms of hedging. Because if people are buying derivatives at those levels, that exposure has to be hedged by the dealers, and that could be another factor that pushes us up towards those levels.
Exactly. And just want to bring it in. I know it's a bit early, but we have got end of month coming in next week, towards the end of next week.
End of month.
End
it's
of
the
month.
19th of June.
I don't care. Next week it's coming in without. We need to be aware of this because it's end of month, end of quarter, and half year end. So it's one of these big moments. If you're going to see a point in time where you may see stocks coming off a bit, it may be into that period because everyone takes some profits on the table to write up the books, book some profits, give a good report for the first 6 months of the year. That's perhaps we might see a bit of profit taking coming into that period. An early heads up, forewarned is forearmed, as they say.
Well, that is very true. I mean, I think traders should also be aware of the Santa rally that tends to take place. I mean, we've only got 6 and a half.
In the middle of summer, come on.
Right, go on. Dollar Chinese. Is this the last time you're going to show us this?
No. Definitely not. No, I've let it off for a couple of weeks because, I wasn't in a position, but I'm back in a position now. I'm back on this bus down into the 712, 711s. I'm seeing this as a pullback off the highs. Again, this has been one, which has been yen-led in part and monetary policy as well, because we've got this difference between the Fed and what's happening with the PBOC. The Fed obviously still keeping their higher for longer and potential hikes in the pipe, but close to a pause or a top. The PBOC going into easing. We're going to potentially get some more rate cuts coming this week and over the weeks ahead. So from the monetary policy divergence play, this is still very much in favour of yuan weakness. And there's been no big warnings still from officials over in China on the level of the yuan and the weakness it's showing. So the green light is still lit for further weakness. I'm long. I'm not going to stretch this trade too much. If we get below 710, 709, then I'm going to be out and I'll look to reassess, maybe look to get in better levels lower down into the low sevens perhaps. That's really going to be the key area. There's a few minor levels in the way, but for me, this is a pullback, gave me a chance to get back on the bus and see where it goes.
Yeah, I think I would agree with that, as you say, and I think I've said this plenty of times before. It is a case of waiting to see what Chinese officials say. They have not really come out and pushed back too significantly against the moves that we're seeing just yet. And until they do so, as you say, I think this is a pullback rather than a change in the trend, so to speak. I think the other thing that you've got to bear in mind, and this is something I think I mentioned last week, is that we're getting so much stimulus out of China. There are clear concerns about the direction of the domestic economy, whether you believe the economic data or not. And I think that's got to be something that's playing on traders' minds here. And actually, you look across the board, developed markets, throw China and a few other EMs in the mix, probably one of very few places where the dollar's actually finding some love.
Yeah, definitely. But again, I think it's a lot to do with that yen move rather than the dollar. Because if you look at something like the yuan yen pair, it's rocketing higher as well. But the dollar side of things, it's one of those ones where it can have an effect in this pair at some points, and at other times it doesn't. But I just like to trade with the trends, and for now, I see the trend as going higher, and that's all I'm interested in.
Exactly. The trend is your friend, as they say.
Trend is your friend.
Someone will be along with a yellow card because I've used a pun or a cliche now. Right. This show is so long this week. Let's get on to our plays of the day. Right. Cable for me this week. Now our producer Kyriakos knows the story of why sterling dollar is called cable. The pound just defies logic at this point. I mean, cable trading at 128. I must admit that the number of times I've scratched my head about that over the last week or so, I'm losing my hair at an even more rapid rate than I was previously. I'm going to look like Ryan by this time next week if we get any further higher. We're at our strongest since April of 2022. And as I touched on briefly earlier, I think this is all a kind of rates and carry story after that hawkish repricing and the sell-off in gilts after the labour market numbers that we had last week, and of course with the market betting on bank rate getting somewhere close to 6% as well. But I think traders are somewhat ignoring the bigger issue here. We're dealing with stagflation in the UK. We've got pretty much no growth. We've got a ridiculously tight labour market. incredible pace of earnings growth, persistently high core inflation and also headline inflation as well, which is leading to signs of a wage price spiral developing. And of course, we've got Andrew Bailey asleep at the wheel of the Bank of England trying to get all of this under control. I think that's probably about as bad a combination for a currency as you can get. I would say, though, that the momentum, when you look at the chart and you look at the price action over the last week or two, is definitely with the bulls. So although I want to fade some of this sterling strength, I would be doing so with a very, very small position and a pretty wide stop, probably around that 130 figure for now. But I do think going into this week, the BOE is going to be very, very tough for them to deliver compared to the incredibly hawkish expectations that the market has priced in. I think the market's got to wake up and smell the coffee at some point, and I would have thought that over the medium term we get back under the 125 handle. This isn't something I think is going to pay off this week, but I think it's a little bit of a longer term one to have on the book. Ryan, what about the yellow metal?
Well, you've been moaning about how long the show's been taking, and you made a mountain out of a molehill with that pound trade. So I'm going to keep
him on. He's not coming back.
I'm going to keep this short and sweet. Gold is what I'm looking at. Pretty simple. We've got a decent range in play here, so we can play this one both sides. I'm not going to be limited to picking one side or the other. On the top side, shorts into 1985, perhaps with a stretch to the 2000 level. If you're through 2010, then we're wrong. On the other side, longs into the 1915 and down into that fib you can see there at 1900, 1901. That's where I played from the long side. A stop just through 1890. Again, don't need to give it much room. That's my play of the day. Short and sweet, but there's no need to make things complicated, is there?
It's very short. Do you want to give us a little song or a whistle for the last 10 seconds?
I can wave my trophy again if...
Oh, no, put that away. Right, well, that does bring us to the end of another show. Thank you, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining us. Thank you also to our producer, Kyriakos, for bringing this together as brilliantly as he always does and putting Ryan's background back to normal as well. All three of us will be back again this time next week. I'm sure there'll be plenty for us to discuss then. If you've enjoyed the show, leave a like on the video, drop a comment as well. Let us know how you're trading the markets, and all three of us will see you again in a week's time. Thanks as always, and goodbye for now.